Well, good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you joining me here on the East Coast. I also want to say good morning to those of you joining us from the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones as well. Of course, good evening if any of you are joining us from across the pond in parts of UK or parts of Europe, and good early morning for any of you joining us from parts of Asia or Australia. Welcome to today's presentation with Kurt out of town. We wanted to spend some time showing how we take the radioactive trading techniques and actually put them into practice, how we use our tools here at PowerOptions to search for new married put trades, some of the concepts of how you can adjust the search criteria to match your specific needs. We're going to take a look at the steps and processes that myself and Ernie Zarenner and even Kurt uses PowerOptions to help further research and analyze their position. And then we're going to take a look at a couple of the fusion trades, the existing fusion trades in my account as well, and see about any kind of potential rollout opportunities or adjustments and how the PowerOptions tools will help you with those as well. Now, for those of you that are very new to the system, of course, what is radioactive trading? Radioactive trading is a complete trading methodology that was developed by Kurt Frankenberg. He came up with the radioactive trading concepts about 11 or 12 years ago, after he had spent $3,000 or $4,000 to learn how to trade covered calls and spread positions over a 2-day period. And then he went out and started trading out on his own, following his guru's advice, and he found that within the first 2 to 3 months or so of following those trading techniques, he had essentially lost all of his money that he had set aside for trading due to a couple significant losses. But he didn't give up. He realized that the money that he lost with the covered call and spread strategies didn't just disappear, they went somewhere. So he decided to reverse the approach of the covered call and decided, well, instead of looking for premium up front and trying to find a force-capped gain of 2 or 3% while leaving the downside open, what if we flipped that and we looked at limiting our risk first and then ways to adjust the position? So we developed a unique form of the married put strategy, and then we used 12 different income methods or adjustments off of that initial setup to further lower our initial at risk, potentially bulletproof the trade, and of course, generate income as well. And the full work is described in the blueprint or the home study kit. Now, PowerOptions is a patented suite of search and analysis tools that Ernie Zarenner designed for self-directed options investors. Ernie created these tools back in 1997. We support over 23 of the commonly used option strategies. Our tools will allow you to search across the universe of options to identify only those positions that match your personal risk-reward tolerance in a given strategy. And then you can quickly compare the risk versus reward and do further research and analysis on the underlying security and the options as well. And we do offer a powerful set of portfolio tools to help you paper trade, track, manage, and evaluate adjustments or rollout opportunities on your positions. Of course, we do offer countless educational articles, help pages, help videos, and archived webinars for you to get more familiar with the tools on the site and the various strategies as well. And lastly, for those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at PowerOptions. I started out as many as you did and was first applied to trade options. I was allowed to do covered calls, maybe buy some calls and buy some puts, and then I expanded later to apply to trade spreads and calendar spreads and so forth. I've been trading for about 12 years now, and I traded covered calls for about 18 to 19 months when I first started out, and I found that I was never getting ahead. I didn't suffer the losses that Kurt did, thankfully, but I was never really getting ahead, really, maybe only a positive 1% after 18 months or so, factoring in all the losses, the management techniques, and so forth. I've traded calendar spreads for an extended period of time, diagonal and horizontal, of course, straddles, long options, just buying calls, buying puts, and credit spreads also. I tried to do a portfolio of credit spreads and iron condors at one point, but I didn't have enough time during the day to manage those effectively. And when I first met Kurt 8 or 9 years ago, 7 or 8 years ago actually, I showed him how to use the tools on the site to identify the married put positions of radioactive trades that he was looking to identify. And although I appreciated that he was limiting risk, I was concerned that he was setting himself to a position which would make no money, that was hedged out too much, and he wouldn't be able to realize a profit. Well, Kurt invited me to invited me to join him for one of his free webinars, and he showed me exactly how he made money with those strategies. And I was so impressed, I invited Ernie to come along as well. And what Ernie did there is he was so impressed with the techniques, he decided to partner up with Kurt and RadioActive Trading. Now, as a result, I've been doing the radioactive trading techniques in my account with about 60% of my allocated capital devoted to radioactive trades over the past 6 years. And the reason why I keep doing it and why I advocate it is because I've made more consistent profits with the radioactive trading techniques over time than I did with covered calls, standard collar spreads, calendar spreads, credit spreads, naked put positions, selling cash secured naked puts, and buying options and long straddles and strangles as well. Bill asked a question, can you post a link to your books? Bill, what you want to do is take a look at traderslibrary.com. I'm going to send that out to you. We currently don't have any of those books that Ernie and I wrote together available here in the office. We don't have any stock available. But if you go to traderslibrary.com, we have one book on cash secured naked puts and another book on collars, and protective option strategies. I still use collars with about 15 to 20% of my trading capital in addition to the radioactive trades. But if you go to traderslibrary.com, and you can either search for my name personally, or you could look for Ernie's and Renner's name. And the two books are Naked Puts and Protective Options Strategies. Sorry, folks, there we go. And I believe now at traderslibrary.com, what you'll be able to do there is also, they offer electronic copies as well as the hard copy of those two books as well, so you can just download the electric copy as well. All right, but let's talk about what we are going to cover today. Today we're going to discuss tips on customizing the search tool on PowerOptions to identify radioactive trades based on the rules in the blueprint. We're going to talk about some of the concepts of changing some of the criteria based on your needs. I'm going to show you how I research and analyze a position and the steps that I go through in opening a new RPM in the Fusion subscription for our Fusion subscribers who are at Radioactive Trading, where they can follow mine and Ernie's real radioactive positions. We're going to look at evaluating what-if scenarios for a new position potentially, and then we're going to showcase tracking the RPMs in the portfolio and using the portfolio to manage and adjust a radioactive trade as well. As we've got a fair amount to cover, let me go ahead and navigate over to the PowerOptions suite of tools there. Okay, what we're looking at here is a basic trial account, of course, but when I'm looking to start a new married put position, following the rules in the blueprint, I'm just going to go to married put, and then we can go ahead and click on the search tool, either in the tools pod or in the main view. If you're opening a new radioactive trade, you don't need to start out with the sample searches, and we'll talk about searching by symbol and insurance later. But we're going to go directly into the search tool to identify a new married put position. Now, when you first open the search, if you haven't made any changes or adjustments or created your own personal search, what you'll see down here at the bottom below the listed trades is we're looking specifically at a default screen for the radioactive sorted by earnings per share growth. Now let me talk about that briefly first. The reason why Ernie feels that we sorted these default results, this default search by the earnings per share growth, is because we feel that the earnings and a positive earnings is going to drive the stock growth slightly more. Sure, we could find a stock with negative earnings and it could have a surprise earnings and have a really big jump, but if I'm in a radioactive trade and I'm taking on a risk of 6% or 7% or even 5% or so, and we're slightly in the money, 6% or 5% in the money, well, we feel strongly that what's going to dictate the growth of a stock over a 2 or 3 month period is really going to be positive growth. We want to see positive earnings. We want to see positive management. So we're sorting by results by highest earnings per share growth to lowest on the default criteria. You can change that at any time. If you wanted to sort by lowest maximum risk to highest or by the lowest net debit total of stock and put, just go into the sort results table down by the parameter field, select which you wish to view, and then you can change it from highest to lowest or lowest to highest as well. Now, as we scroll down further below the listed trades, in the search, you're going to have 4 basic criteria. It's annual, Ross. The earnings per share growth that we show on PowerOptions, percent earnings per share growth, is an annual look. Okay? All right. Now, you're going to have 4 different sections of criteria that you can adjust when looking at any search in PowerOptions before our new in addition to our radioactive trades or married puts. We can set our options criteria, the stock technicals, the stock fundamentals, and of course, screen by a specific list. The default criteria that you see here on PowerOptions is based on the discussion in the blueprint, I think in the 3rd or 4th chapter, of stock selection and married put, setting up the married put position and stock selection. Over on the right-hand side, we can see the specifics of what we're using right now for this default search. Following the rules in the blueprint, we're looking at a put option that's at least 150 to 900 days out in time. This follows one of the 3 core principles. We want to take a look at also the ATM bell curve, but we also want to look at what Kurt calls the red line, okay, the time decay value. We have the lowest time decay when we go at least 90 to 120 days out in time. Since we're buying the put for protection, we want to see the lowest time value of those first couple months before we get to expiration. So we're going at least 5 months out in time. We're going to keep our maximum risk between 3.5% and 9%. We have a strike listing here of between 1 and 2, and we don't want to go more than 20% in the money. And the reason why, of course, is just what we talked about earlier. When I first saw Kurt's initial setup, I could find positions where the stock's trading at 25 or 30, and I might be able to find a 50 strike put, for example, that's almost 100% in the money on a $30 stock and only costs $20.20. So I'm taking a very low risk of 20 cents, which would probably be less than about 0.1%. However, when you go too deep in the money and take too low of a risk, you're lowering drastically your expectancy of profit. You need such a large move in the stock in order to realize a potential gain on that position because you're so hedged out. This is discussed in the rules in the blueprint why we're not going more than 20% in the money, but we've already set that as well. In addition to that, we're looking at an open interest of just greater than 0. Now, following Kurt's suggestion, which works for him over the last 12 years, he's looking for an average stock volume of greater than 300,000. We do want to see some volatility in the stock. I've had success over the past 6 years on lower volatile stocks that pay a high dividends and are large cap stocks. Johnson & Johnson was a very successful radioactive trade for me. Hertz Global, I had success with SPY when the volatility of the stock was below 0.15, for example. But in general, we want to see some movement on the stock. We want to see some fluctuation, and that'll help us with the option premium and the various income methods. But again, the blueprint discusses if you're doing dividend stocks, use a smaller portion of your radioactive portfolio. Mine personally is about 20%, 10 to 20% of my positions are in dividend-paying stocks, and then the rest are in more volatile stocks with the protection in place. In addition to that, we're looking for stocks that are trading in an uptrend. Now, another factor here is that we're looking for stocks between $9 and $200. It's just a basic default that's set. Now, you'd think that this is a pretty open screen. A lot of stocks have put options, or at least 150 days out in time, would have a risk between 3.5% and 9%, with less than 20% in the money. Even with the recent pullback, there's still a fair amount of stocks trading in an uptrend, and there are stocks that have good volatility as well. So why do we only have about 12 results on this default search? Let me get rid of that highlight there. I apologize, folks. I thought I'd cleared that out. That's a little bit better. Well, one of the main reasons why is that Kurt prefers to look for stocks that are in the IBD 50 and CAN-SLIM list. So the other default criteria we have set here is looking specifically for stocks in those lists. But do you have to use the stocks that are in those lists? Absolutely not when you're opening a new radioactive trade. Do you have to keep this default criteria set and not change it? Well, this is the exact search that Kurt, Ernie, and I use when we're looking for open a new radioactive trade. But you can make changes as long as you stay in the rules that match your investing needs. As many of you know, if you're a PowerOptions trial member or you're a subscriber, you can schedule one of those free coaching sessions at any time. It's essentially a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. One of the first things that I'll discuss with any customer that's interested in the blueprint or interested in radioactive trading, maybe you just recently purchased the blueprint, when you call up for a coaching session, you call up and say, I want to know how to use the search to identify these positions, the first thing I say is, let's go to the fundamentals tab. And again, we could set things for earnings per share growth. If we just want to see positive earnings per share growth, that's fine. If you did have a requirement for market cap, you only want to see mid to large cap stocks, for example, you could put that in as well. But the first thing I tell customers is that I know my account size. I do not know your personal account size. I don't know how active you're going to be with the radioactive trading if you're just getting started out, and I don't know how much cash you're going to allocate to it. You know that. I don't need to know that. But what you do need to know is that this is just a default setting for the stocks. If you've only allocated a smaller amount of capital to try radioactive trading techniques or to put into your portfolio, the first thing you're going to want to do is you're going to realize what kind of stock price you're going to be able to trade, whether you're planning on doing 200 shares or 300 shares of stock and 3 puts or 200 shares and 2 puts. So in general, if your rule dictates that you're not looking at stocks higher than $85 per share, then we were just going to change the stock price field. I might even lower this just in case there's a small stock, a $5 or $6 stock that still matches our criteria. So we'll go 5 to 85, and let's go ahead and submit that. So we've narrowed this down to 6 results: Fleetmatics, HealthNet, which I've been looking at recently, Arista Networks, I haven't seen those pop up recently, Blackhawk, which I'm currently in, Outerwall, and Lynette, which I don't know, but I kind of like that price there. I like the price of Fleetmatics too. As a matter of fact, I think Ernie's in Fleet Core right now. He's not in Fleetmatics. The second thing that we'd want to do, and you would have heard this, of course, on the webinars, and you would have seen this in your blueprint. We do have a wide range of risks here, not really wide, but going from about 5.9% to 8.4%. As you start getting deeper into radioactive trading, you'll of course realize that, well, you'll have your own preference of the maximum risk that you're willing to take. And I don't have any kind of statistics that show that this is more profitable or less profitable. I just have a personal preference for my risk threshold. So in my personal account, I typically adjust this risk to be between 3 and about 7.5%. I prefer not to take a risk as high as 8% or 9% when I'm first opening my radioactive trades. So we'll submit that. We'll take another couple out of there. So now we're down to, again, just 6 total results that match our criteria. Okay, we're all within the risk threshold range we're looking for. Other than Outerwall and Lynette, we see everything with a positive earnings per share growth, and we have some decent open interest on all of these positions as well. Now, what are some of the other things you might want to change? Right now, I wouldn't worry about the ask time value. I wouldn't worry about IV over HV, but if that's something you like to screen by, you can enter that as well. You can change the strike level if you want to, or the range in the money, but if you want to allow for more positions, you want to increase your percent out of the money, I would suggest not going higher than 25% at most. In fact, I usually keep my screen down to less than 15% in the money, personally. Okay, so we can just, and as you make a change, just want to submit it basically. So we open this up for another couple ones that came in here: Horizon Pharmaceuticals and the South American company, it looks like here, Criteria SA at the top of the list, CRTO. If you wanted to look for higher open interest, that's fine as well. Now, a common question that comes in, hasn't yet, but a common question that comes in when new investors are looking at the radioactive trades, setting up their screen, the first thing they want to say is, well, what delta should I put in? Well, I don't pay attention to delta or implied volatility, honestly, with the radioactive trading techniques when I'm opening a new position. The reason why is because of this basic criteria that we're using. By keeping our risk within a reasonable range and keeping our range in the money also within a reasonable range, I am already filtering by delta and implied volatility, even though I'm not. So let me very quickly, let's go up here and let me go ahead and choose columns. And we're going to do another example of this later, excuse me. But sorry, let me open that up full screen, folks. I apologize. So in the choose columns here, we can select anything we want to see for the stock. I might also want to add in where's my earnings date as well coming up for the particular position. But I'm going to select delta, and then I can also select implied volatility. Okay, let's go ahead and submit that. It's just going to ask us to refresh the page there so we can add in those new columns. All right, so now what did I say before? I'm not looking at delta specifically. Why? Let's take a look at the delta ranges for our 8 positions that matched when we made some changes. The lowest delta or highest, we've got a negative 0.55. Looks like our highest is a negative 0.63. So even without screening for delta, I'm with an extremely tight range of only a 0.08 difference for delta. What about implied volatility? The lowest is 0.2423, and it looks like the highest is 0.5208. So even without screening for implied volatility, I already am, based on the other factors of keeping my risk within that limited range. If the delta was too high, absolute value, if we had a delta of 0.8 or 0.9, the risk would be down below 3%, so I wouldn't see it in my results. And if the delta was too low, if it was only at 0.5 or 0.4 perhaps, there are some 0.5s in here, but if it was about 0.4 or 0.45, the risk would be higher than 7.5. It'd be at the money or slightly out of the money, and we'd have a risk higher than 7.5%, and that also would not appear in my results as well. Okay, Paul, I'm going to get to your question in just a moment. Now, as I mentioned before, other things that you may want to change here, we talked about change the risk, but keep it in that level. And if you have a higher risk threshold, you can increase that up to 10 or 12. I wouldn't do that personally, but that's, again, personal preference. You can change the days to expiration, but following the rules in the blueprint, I would keep this at least a minimum of 150 days out in time. But if you want to see things that were limited to less than 200 or 270, you could change that as well. For the stock technicals, there are some times when I increase my average stock volume up to 750,000 shares per day on average, and I'll keep the volatility the same. Okay? Or I could do the mid to large cap. You see here, I greatly filtered those results down to only 3 positions that would match my personal criteria. And we talked about the fundamentals as well and other things you could change. Now, going to Paul's question, Kurt has set up the screening criteria using the IBD 15 cancel list because he's had success with the stock selections for the IBD over the past 10 years when he started putting together the radioactive trading techniques. Remember, the basic setup, I'll take a look at the health net profit and loss chart here. The basic setup of a radioactive trade is a protected stock position, and it is a bullish strategy. So does it have to be an IBD 50 and cancel him stock? Absolutely not. The idea behind it is to find a protective position that you're personally bullish on, that you think a stock that you feel has a potential to maybe grow 5 to 8% or so in the next 30 to 60 days, but over the course of maybe a few months may see a growth of maybe closer to 8 to 12%. That's how I try to evaluate my positions based on my analysis, okay? Now, to Paul's question, Paul wanted to know, can you add a watch list of personally tracked stocks? Absolutely. And in addition to that, there's several things we can do. Number one, if I prefer to use stocks, let's say, in the S&P 5-star group, stocks that are rated 5-star buy by Standard & Poor's, I could just change that. Instead of using IBD 50 and cancel them, I can use the S&P 5 stars, and we can submit that list. And we're going to see some different ones. Sun Edison, which we're going to look at later in the portfolio, and JetBlue Airways came up. So these are the only 2 stocks right now, lower priced, but they're in the S&P 5-star list that match our requirements for put range, maximum risk, open interest, and so forth. But as Paul mentioned, I can create a stock list at any time. So if I click on Create and Modify Stock Lists, there's 2 things we can do here. I can go ahead and create a stock list, and we'll call this Paul's example. And these probably aren't his stocks as well. I can paste stocks in from a list if I'm using, I have several PowerOptions customers who use VectorVest, and they get a list of stocks based on their criteria from the VectorVest tools. They'll paste that, or copy that, come over to PowerOptions, create that list, and then run different searches and different strategies against the list. Someone might put in some fun ones that I know. Let's say Johnson & Johnson and CAR, Avis Group, worked well for me last year as well. And maybe Starbucks, maybe Apple. And let's say, I don't know, I'm just running out of stocks here. IBM, for example. Let's see some of the other ones. I'm in Hawk right now, as I mentioned. So you can just plug in your list of stocks or paste it. So I'm going to go ahead and create that list right now. And it just says here, Paul's example, and I see that I have 6 stocks. Okay, so once I've got that done, we can go ahead and close the window. You go back into the lists field, and I have other ones. You see here I have combined leveraged and inverse ETFs, which I actually use to exclude when I'm running different searches for credit spreads and for collars as well. But here's Paul's example. We only had 6 stocks in there, but I can go ahead and submit that. Okay, so none of those 6 stocks have requirements here that match our default criteria, which is interesting. I thought Blackhawk would. I know why it doesn't. I'm sorry. let's see here. Let me change that, see if that works. Yeah, Blackhawk only averages, I think, about 540,000 shares per day. But there's the Blackhawk position that I might consider getting into today if I still had a bullish sentiment on that particular stock. So you can create your own personal list, paste that in there, Paul. And now, once I've created that list in the list field, this list will be available in any strategy. So if I'm also doing bull put credit spreads and I want to screen against that list, I could go into the bull put search and pull up that list as well. And as I mentioned before, when you're in the create and modify list field, you can also click on the link in the upper right here to combine lists. And what the combine list allows me to do is I could add Paul's example to the IBD 50 and IBD Can Slim, S&P 5 stars. Oh, I don't know. Let's just put in the NASDAQ 100 as well. Okay, so I'm just going to call this list name combined list. S&P, NASDAQ, IBD, and then of course Paul as well. Whoops, no space there. So okay, so we're just creating a list. Go ahead and create. And now this combined list now has 309 stock symbols in it, so I could screen against that as well. Okay. Oh, Bill, wow, Bill, fantastic. Bill just went out to Trader's Library that we talked about earlier. He just purchased that Protective Options Strategy book. That's great, Bill. You'll receive, as you mentioned, a trial period for purchasing the Protective Options Strategies book over there. But you can start that at any time. So Bill says he's going on vacation. He's going to start the trial later. It's no problem, Bill. That trial won't start until you first log on to your account. Okay, so let's go back now. Let's close this window here. We've got our criteria set. Now, for a basic view, we're going to do one more thing here, and then we're going to talk about research and analysis. We talked about changing lists. We talked about using the default criteria as a stepping stone to stay within the ranges. But can you create your own personal search for RadioActive Trade with just a few steps? Absolutely. You just want to remember the rules, and you just want to remember to keep it simple. Let's go ahead and clear the filters. I'm going to empty everything out of the parameter field right now. And I'm going to start off with the basic requirements I'd use for the put controls RadioActive trading. So I'm going to start off with my options field. I know I want to be at least 150 days out in time. And let's keep this down to 300 days. Okay, so we're not going to go more than 300 days out or so. Actually, yeah, that's fine. I'll put 300 days for the time being. Not a recommendation or suggestion. There's nothing wrong with going out to the 2017 leaps if they're available right now, if it still matches your risk. We're just using this as an example. Speaking of risk, what is my range? I'm going to put that in first. Let's go ahead from 3% again to 7.5%. I had mentioned before that my range in the money, I don't like going more than 15% in the money, so I'll plug that in as well. Delta, of course, we're not going to use. I'm going to use an open interest of at least 2 contracts over time, and I'm not going to worry necessarily about the option volume today. Now, I could limit this. Many of you know that when you're searching for the married put positions, when you look at puts that are 3, 4, 5 months out in time on a volatile stock or that doesn't have a lot of activity, you may see a $1.50 or $2 bid-ask spread. Well, if you wanted to restrict that to look for positions that had lower than a $1 bid-ask spread, for example, we'll just plug that in the price and strike price fields. Now, one thing here I wanted to mention too, the net debit field. That's the combination of the stock and the put price. Now, it's good to limit the stock price, but in general, if I know that I'm not putting more than $85 into a new RadioActive trade or a new married put position, I might limit my net debit to be less than $85. So that's stock plus put. I might not use the stock price filter because this would already take care of that. Okay, so this 3 criteria here, you always want to make sure you have. You know, we recommend going at least 150 days out in time. I do have some RadioActive traders that go only 120 or 110 days out in time up to about 250. Again, it's personal preference. I like going further out to have more time value on my side. Set your risk factor within the range. Under 9% is what we advocate in the blueprint. And your range in the money, you don't want to go more than 20%. These are the 3 core principles of RadioActive trading, as we talked about before. Following the red line, the radioactive decay line, the time value, so we don't see that rapid time decay on our insurance. This is fist or forcing an ideal size trade. That's one of the other 3 core principles, of course, that we don't want to keep our risk within a limited range. And it also helps with the position management also. And then, of course, the expectancy of profit. It's really the at-the-money bell curve, what we call the ATM bell curve. But these three are the ones that reinforce those three core principles of radioactive trading. And this is more of a personal preference. I know my account size, so I've limited my total net debit to be less than 85, and I'm going to try to limit my bid-ask spread to be less than $1. We may have to increase that if we don't get a lot of results. Now, what's next? Well, what did we just talk about? We want to look for a stock that we feel maybe has the potential to grow at least 5 to 8% or so, maybe 4 to 6% in the next 30 to 60 days, but has the potential to grow maybe 8 or 10% over the course of the next 8 months or 6 months or so. Now, if you have a preferred list, we already showed that. I could create my own personal list and select that and just screen against the list. However, I'm going to leave this up as no lists right now. And let's go into the stock fundamentals. When I told you that I could put in a stock price range of, let's say, 90 or 85, I already took care of that with a net debit, so I'm not going to worry about it. I want to see stocks that have a positive earnings per share growth. So I'm going to put in an earnings per share growth of at least 5%. And in general, I may look for a relative PE of 0 to 70 or maybe 0 to 50. Again, that's kind of personal preference, but it's something I like to use. And if I didn't want to see any fly-by-night companies, I want to see companies that are more stable, I may use the market cap field. And this field is actually measured in millions. So if we wanted to look for stocks that had 2 billion market cap or higher to go to the mid to large cap range, I'm going to put in a market cap of at least 2,000. Now let's go ahead and navigate over to the technicals. And of course, if I wanted to look for stocks that paid a dividend, I could put in the dividend yield of at least maybe 1% or 2%. That's the annual yield. But again, I only trade the dividend paying stocks about 20% or so of my radioactive trading portfolio. So I might have a search that's looking specifically for dividend stocks and one that's not. Lastly, I may go into the technicals, of course, and I may look for, we talked about it before, that average stock volume of maybe greater than 750,000 shares per day. I want that historical volatility of at least 25%. And again, I'm just going to use the basic simple moving average to look for stocks in an uptrend. So what am I doing? I'm looking for stocks that have shown good earnings, have a relative PE within my price range, only mid to large cap stocks that have a good average stock volume, and right now are trading above their 50-day moving average. And they have to have the risk that I want, as well as the range in the money, and of course, the bid-ask spread is maybe the only complex thing I put in there. All right, so out of the total universe of options, we have only 34 results that match our default criteria, and that's looking at all lists, okay, all 4,400 optionable stocks, indexes, and ETFs. We actually don't see any indexes or ETFs here. Now, you might ask, why are you not seeing any of the ones we saw before? When we were running that other search, we saw positions that were, I'm sorry, in the IBD 50 and cancel list, there were 2 or 3 positions in there, and they're not showing up. And again, one of the reasons is because you notice those last 2 that were there, the Lannett Company and not FleetMex, but the other one, they had negative earnings when we first pulled up that list. I put in it had to have an earnings per share of at least 5%, so we filtered those 2 out. The other filter that came into play is the average stock volume. I remember we took out everything but one result when I increased my average stock volume to 750,000 using the default parameters. So are these positions better than what came up in the radioactive trading positions? Well, I don't know. We can't know the future, which is why we're trading with the put for insurance to keep us out of trouble. One other thing that I could do here, of course, is limit this to just one result. What? We see that Owen Corning has come up on the results here. This is our first one. We have multiple strikes. February series, the 44, 45, and 46 are all within our range. I'm going to talk about that in just a moment. As well as the January 43, 44, 45, and 46 are all within our risk range. Now, Ernie likes to use a new filter that we've added in the last couple of months to help with his selections. I'm sorry, it's in the options field, and you can just select one result per security. So what it's looking at is sort of the one that's sort of the most, not the highest risk, but the one that's sort of in the mid-range there, the one result per security. It's going to have the one that has the closest time frame with the best risk available. Now, I'm going to leave it off for right now, and I'm going to discuss something here. When I have multiple positions on the same stock that come in my search, as we do for Owens Corning, Okay, again, we have all the February and we have all the January issues. Let's clear this up a little bit. We'll come back to it. I'm going to use a little trick here. I'm going to go into the fundamentals. I'm going to search by symbol by just OC. Okay. All right, so we just narrowed it down to just the Owens Corning's one. Which is the best option to trade of these actually now 8 results? Well, there's multiple things that come into play here. Number one, when I have multiple positions of the same stocks that match my search, my focus is going to first go on the farthest out one. Because as we know as radioactive traders, the option that is further out in time is going to have the lowest cost per day. The cost might be higher and the risk might be in a relatively high range as well. But again, this is based on the factor of my cost per day is lower. So I'm risking only 5.9% out to March, which is 253 days away from the March 46 put. But that's even below what we're seeing for the February series and for some of the January series that have a shorter term. But it's a 46 strike on a stock that's trading at $40. So although my eyes want to go to the one that's furthest out in time for the longest term protection and lowest cost per day, I'm going to have to do, of course, further research on these positions. The first step that I do, whether this was all Owens Corning's or whether it was just a list of stocks, we're going to take the first one. But what I want to do first, anytime I run a search, is now that I have my results, is I'm going to go to charts and I'm going to go to big charts. Now you can customize big charts. We're going to walk through how I customize it, but everyone has their own personal preference. What I tend to look at for a radioactive trade is I want to set my time frame to only about 6 months for right now. You can always toggle back if you want to see more distant and look at the last 4 earnings or more earnings as well on your position. But you can do that also. Sorry folks, 1 second. There we go. Now, we can set a variety of different indicators. And the one thing I'd like to use, I'm going to go ahead and look at a 20-day moving average. So I'm going to select moving average SMA, greater than 20, or see the 20 line. The reason I do that is because I do Bollinger Bands when I'm looking at my positions. And the Bollinger Bands, of course, is based on the 20-day Bollinger Bands, so it's nice to see the 20-day moving average line between them. I also tend to look at MACD, and I may look at RSI as well, and then, of course, volume. This is personal preference. Other things you look at if you tend to focus more on the fast or slow stochastic. Williams percent R is one of the ones, and you may even have your own stock charting system that uses your broker or a separate service, and that's perfectly fine. But I'm going to go ahead and draw the chart now, and this is going to show me my 6-month chart here for Owens Corning. Actually, I'm going to narrow this down here based on the screen size to 3 months so we can get a better view. Now, what am I looking at here? Remember, what I wanted to see is a stock that I feel has the potential, of course, to move up 5 to 8% or so a couple points within the next 30 to 60 days. I probably think my expectation, I'd want the stock to be trading at 42 or 43. I'm going to go down to 1 month so you can see this a little bit better again. Some of the things that are concerning me, the stock is trading right around its 20-day moving average. That's good. It hasn't broken the upper Bollinger Band, and I see the Bollinger Bands are condensing. That might be considered a positive thing, looking for a potential breakout. And the stock's just moved below its 20-day moving average today. The MACD does concern me. There was a recent crossover, and the MACD is pulling away from the signal line, which usually indicates a downtrend, and we can see that. Yes, it's a lagging indicator, but at the same time, we can see that as well. RSI is dropping to that lower range. It's dropped below the mid-range. You know, a lot of people say if it's up at 80, it's going to pull back, and if it's down towards 20 or 30, it's going to bounce up. Well, this is in the mid-range, and it's just pulled below the 50 line. So, you know, and of course we see here there's lower volume. Volume's been declining as well over the past couple of weeks also. So those are things that I would consider a concern. I'd like to see a positive MACD. I'd like to see a stock above the 20-day moving average and going left to right, of course, lower left to upper right and approaching the upper Bollinger Band. And I'd like to see a more strong relative strength index instead of a declining one. Okay, so now, but let's talk about when I have multiple stocks that have the same risk. As I look at this chart, then I decide to myself, well, maybe I'm not comfortable with this, but if I did like this stock and my target point for this stock for the next 30 to 60 days was, let's say, around 42.50 or maybe 43.50, somewhere in that range, that now is going to help me dictate the strike. Because what I want to use when I select the strike price of my put is where I think the stock might be trading in the next 30 to 40 days. That's going to be the best opportunity to do one of the more bullish income methods such as 1, 6, 5, or 4, which will most greatly help me reduce my risk, generate premium on the position. So knowing that my range is probably around 42.5 to 44 or so, my focus now is probably going to be on the January 43, maybe the February 44 with a risk of 6.7%, or perhaps the January 44 with a risk of 6.1%. And to be honest, even though the risk is higher, if that's my expectation, looking at the chart that my projections the next 30 or 40 days, I think the stock would be trading at that strike at around 43. I'm going to be very tempted to go with this trade. All right, now let's take OC off the list. Well, not off the list, but let's look at everything that matched our original criteria. And let's go back into the options field, and I'm going to just for simplicity select that one result per security. Okay, so we put in our criteria. We ran our searches. The 43 didn't show up here, but we're going to talk about that in a moment too. So again, how am I going to further research and analyze these 14 positions that popped up on my screen? First thing I'll do for any position is I can take a look at the chart. And as I mentioned, we're going to go to 1 year snap. We can go to big charts. We'll have it customized, and you can store those settings. I already said that I probably didn't like the chart on Owens Corning, so I may check to look to see when the next earnings is coming up and when the earnings expectation is, maybe for a little pump. But I kind of didn't like that chart the way it looked. So at this point, I'm no longer going to further research and analyze Owens Corning's. I don't like the cruise lines, personal preference. I know it's summer and they're probably doing a lot of their booking and a lot of their earnings right now, but that all being said, Norwegian Cruise Lines, our second one, stock at 56.05, 4%, 7% in the money, 60 strike put for December with a cost of 6.30, but our risk is only 3.8%. It's fairly low. So let's take a look. Once again, first step, I'll go to stock chart, 1 year snapshot in big charts. Sorry, I'll just spend half a second here resetting these. I forgot to save it last time. Sorry, so it's 20-day SMA. Personal preference again, but we're just going to use the same ones. We're looking at relatively the same chart we were looking at before. All right, folks, there we go. Okay, let's go ahead and draw that chart. And I'll store the chart settings real quick. All right, so this, well, this is more along the lines of what I'm looking for. We've seen some growth. It's hit the upper band and pulled back. It had a decline recently, but then it had a breakout there. This is probably due to earnings. And it's been keeping at or above the 20-day moving average and still kind of moving lower left to upper right. This looks positive, but again, I'm concerned about the MACD line that had the crossover recently, and it's starting to show weakness. Okay, so what is up at the band, it was up probably 57, 58. Now it's started to pull back. For a simpler view, I'm going to change this again, folks. I'm sorry. And then we're just going to go back. So if that's one of the preferences, it's not going to be your preference, but if I use MACD and I look for a positive MACD when I open my positions, then I'm just going to go ahead and close this now. I'm not comfortable in Norwegian, so I'll move to the next one. ASNA Retail Group. I don't know who they are, but again, first process again, charts and big charts. So try to find something positive. Nope. This is all due to the recent market activity as well, and that's another factor. But this one is pulled back, dropped below the SMA 20, and it's condensing in. This might be a buy opportunity, but the range here only going up to 18. So let's simplify this. I already told you that I'm looking for something that has a positive MACD, so why don't I just do that to narrow this down further. So I'm going to look for MACD where the MACD line is at least 1 day over the signal line. Don't know if we're going to get anything. There we go. Burlington Stores, JetBlue, and AEO. Like the risks here, 5.4, 6.3%. Good earnings per share growth on Burlington Stores. Retail's kind of tricky, of course. We all know that. But then let's go to big charts, and let's go to big charts. Okay, so this had a concern recently pulled back, dropped down. Could have been due to earnings, could have been due to poor sales. Oh, sorry, Ross. Yes, I was taking too much time probably by just putting in that filter because it's something I used to narrow this down. All right, so long story short, the stock that pulled back recently, it's been moving up. We see it's crossed the MACD line, and the RSA is increasing volume. Not as strong as I'd like to see, but we know it matches my requirements of at least 750,000 shares per day on average over the last 90 days, probably due to this big event. So we like this chart a little bit better, but we did see something that caused us hesitation. My second step when researching my results, go back to the More Information button, and I'm going to go to the Company Information and News. First thing I want to take a look is the recent news headlines. That just links you to Yahoo News, but I'm going to go back to that date where we saw that large decline and that high volume, and I want to see why. What happened during that stock? Is it something that's longer term concern, poor earnings perhaps, with a projected slower quarter for the next quarter? The stock's recovered some, but if we're concerned that the next quarter is going to be low as well in comparison to last year, that may be a concern. We do have a 20% earnings per share growth, but something happened to that stock, and I'd want to know it. Other things that you'll see in the news that you want to look out for is any discussion of a boardroom change, a pending patent lawsuit. You probably won't be seeing a lot of biotech stocks in here that match your risk threshold for the married put, but you'd want to know if there's any FDA approvals or anything of that coming on along the lines. That's also helpful to know with things, some of the larger pharmaceutical companies even, Celgene and things of that nature, if they have some drugs in the pipeline that's not really their drug, but sort of a third company, if they can take a hit from a failure of an FDA approval that they're kind of financing or they're funding, you'd want to know that as well. So anything that might cause you hesitation to enter the stock, you want to know ahead of time. And just like I saw with the chart, if I saw any news article recently that caused me concern, I would just stop researching Burlington stores now, and I'd move on to the next position, JetBlue. The third thing I do after I look at the stock chart to verify it's a chart and it's something I feel confident has the potential to move up maybe 4 to 6% in the next 30 to 60 days. I didn't see anything in the news or information that would cause me hesitation. I could look at the earnings. What I tend to do is just go into the stock research tool in PowerOptions. This gives me all of the available data that we have for Burlington stores there. And we see that our earnings per share goes about 19.82. Stock does not pay a dividend, but now I kind of see it. That last event was in June, so our next earnings of 9.8, this stock has already had earnings come out, so that's something that I might be concerned about as well going forward. I'd have to go to research that earnings report a little bit more to see if they're projecting that this one's going to be as affected for whatever reason. But who knows? By September, they might get a bump with going back to school sales at Burlington stores and so forth. We'd have to take a look at that also. We see the our put volume and put 69 contracts, and the open interest looks good as well. And we're just looking at some of the, it's a strong sell, strong buy recommendation, excuse me. Everyone's a strong buy on this one, but it's not in any of the recommend lists. Really what I focus on in this page is, am I looking for earnings, and does it by chance pay a dividend, and of course the earnings per share growth. Those are all things that I could add into the columns, but I like to see it here as well. All right, so we decided we liked the chart. We would do more research and analysis looking into the last earnings. Why was it so poor, and what is the projection going forward? I want to take a look at the research tool. Now again, this stock's at 52.91, and we're looking at a December 55 put with a 6.3% at risk. So one thing I may want to do, are there any other options available? Is there a 52.5? Probably not. Would I be more comfortable with a higher risk, maybe the 57.5? Or are there January options available that still keep me within this range? We'll go ahead and let's go to search by symbol. The search by symbol tool shows me, okay, well here's our December 55. It's highlighted in red. This is the one that was on our search. It has the risk we want. No 52.5, we only have the 50, and the next strike, that's actually out of the money, and of course, since it's out of the money, it's got a risk well beyond what I want to see. Now the 60 is there as well, and it's offering a low risk of 3.4%. It is 13.4% in the money, it's within my range, but after looking at the chart, I don't think I'm expecting the stock to go near 58, 59, or 60 within the next 30 to 60 days, but I was more close to the 55, so this is the choice that I would look for. Okay, that's John says, so the amount of risk is the net cost of the close of the married put, but what's the best way to unwind before that X date? That's what's discussed in the blueprint. Okay, we have a full chapter on exiting the RPM and exit strategies, and I'm going to showcase this a little bit right now. Well, first what I might do is I'm going to go to January. Now remember, our 55 is offering a risk of 6.3%, so I want to take a look at January now. Let's go ahead and submit that. Oh, okay, so we don't have anything for Burlington in January. That's very interesting. It doesn't offer a January series. It's December. Is there any in February? Nope. That's interesting. March? Different series, of course, have different cycles. I doubt it will have in April. Okay, so we're just going to leave that alone here. We're going to stick with December because I'm not seeing anything else that matches. But what I'd want to do with January is see if there's a possibility if that risk factor there for the December or the January 55, if it only went up to 6.5% or 6.6%, only gain of 0.2 or 0.3% for an additional 30 days of time, I'd be more tempted to go with the January. Mike says, how do you define ITM versus OTM? Oh, okay, well, for puts, in the money is anything that's higher than the current strike price. So the 55, the 60, the 85 that popped up here, the 65 and the 70, these are all in the money puts because they're all above the put strike price. This price here, let's go to the profit and loss chart and I'll explain that a little bit better. So in the money for a put, now to set up this RPM, I'm going to buy the stock at about 52.91 and I could buy the December 55 put for 580. Okay, the 55 put, let's call it 53 even. The 55 put is $2 in the money. So it has $2 of intrinsic value. The remaining 380 or so, it's okay, so it's 210 if we're looking at the stock at 52.90. Let's use 52.90. So we're $2.10 in the money. So that's intrinsic. The remaining 370 of my 580 price is the time value or extrinsic value, which is equal to the maximum risk. With the out of the money option, if I chose the 50, the price of the option is all time value. It's probably lower. It's probably only $4. That's all time value, but the insurance wouldn't kick in until the stock dropped below 50. And I don't want to take an 11 or 12% risk on the position. So for puts, if the strike price is above the current stock price, that's in the money. For a call, if the stock price is below the current stock price, that's in the money as well. Okay. Okay, now Bill, here's the risk percent that we're talking about. And I'll go back to that search by symbol in a second. The maximum risk for a married put position, as we're identifying them, is the total cost basis of the position, right? So I had to put in 52.90, and I'm going to buy a put at 580, so my total cost would be $5,870, $5,870 for 100 shares in one put. I am guaranteed to get 55 back no matter what happens, the absolute worst case scenario. So my maximum risk, even if the stock dropped to $1 per share, at any time between now and expiration, the most I can lose is $370. We've got a limited risk guaranteed in place, and we have unlimited upside profit potential. So the risk, this percentage risk and the max risk, is the total investment minus the strike price. That value is your maximum risk. That divided by your total investment gives you the percentage. It's what we call the 5-line setup at RadioActive Trading. Okay. All right. So Mike, yeah, if the call is above the current stock price, that's out of the money. If it's below the current stock price, that's in the money. All right. Now, what I want you to pay attention to, and most of you are aware of this, I know there are a lot of blueprinters online. When you're looking at this profit and loss chart, the blue profit and loss graph, the blue line profit and loss graph here, let me just turn that off. There we go. This is our profit and loss at expiration. Is my break even 58.70? Yes. If I hold the position all the way to December expiration, I choose to make no adjustments over that 6-month period, I would absolutely, well, okay, it's 5 months now, 5.5 months now, but I would definitely need the stock to be trading over 58.70 in order to make a profit. Well, what about this curve red line? It looks here the break even's only about $56 or so. How is that possible? Because the put, remember, we had a lower delta on the put. We saw that all the deltas that were only around 0.6 or 0.55, for example. The put does not decay one-to-one with the stock. In fact, I'm gaining positive delta on this position as the stock moves up. The stock moves up 1 point today. I'm probably going to lose 55 cents on the put, gain $1 on the stock, so I'm up 45 cents on the position. It goes up $1 the next day, I'm probably going to lose 52 cents on the put and gain another $1 on the stock, so I've gained another 48. So now remember, we were thinking about, I want the stock, I would open this position if I had the expectation that Burlington Stores may go up 3 to 5% or so within the next 30 to 60 days. So let's just take 5%. 5%, of course, of this value would be around $2.60 or so. So let's say that this stock does move up to $2.60. That would put us at about $55.50 in the next 30 days. So I'll go to August 10th. Sorry, folks, missed it. There we go. All right, so let's go ahead and calculate that. Now, the curved red line is now showing us the profit and loss of the position at 30 days from now. And notice, even if the stock's trading at 55.50, we'd have a gain in the stock of 259.50, but we're only going to expect a decline in the put of maybe $2 or so. Actually, I know it's going to be less than that with the bid-ask spread. So we are going to have a positive profit position. Okay? We're going to have a small gain of 51.50, not a lot, 50 cents, but is the stock trading at our 58.70? No, the stock's only trading at 55.50, and we still have a gain on the position. Okay, so it's not that we're down $3.70 when we first opened this position. All we're risking is the bid-ask spread on the put. And what we're doing here, we had mentioned earlier, we're going to evaluate what-if scenarios. Well, this is my what-if scenario. I'm going to use the field here to decide, okay, am I still comfortable with the potential gain on the position, or how the position would look if the stock does go up to my price, my target price in the next 30 days. I'm not going to exit at that time. That's going to be the opportune time to apply one of these different income methods from the blueprint. But in the same course, I want to know what happens if I'm wrong. And I'm wrong about 45% of the time. I actually a little bit less than that, around 42, 41% of the time. I'll just pick a stock and it goes the wrong direction. So what happens if the stock drops 5 or 7 points? What would my position look like there? Remember, my maximum risk was 370. Well, if the stock dropped about 7 points, we have a loss of 740 on the stock, and we'd have a gain of around 440 on the put. So I'm not near my maximum loss yet, but I'm kind of getting closer to it. And that's okay, because I would have opened this position knowing that if everything fell out of bed tomorrow, I was comfortable taking this risk of 6.3%. Okay, now, common question. And not even common question, but something that comes up. This is my last step here, running my what-if scenarios. Many of you are familiar with the blueprint. Many of you are familiar with the various income methods. And you want to know, well, okay, I get what you're doing here. You're buying stock. You're buying a put. You've got something that's about 160 days out to expiration. You've got a limited risk of $370 or 6.3%. Of course, if I open this position in my portfolio account size I'm trading with or allocating right now is about 40,000. So I'd make sure that my monetary risk in this position, again, following the rules in the blueprint on setting up the RPM, this position would risk only 1 or 1.5% of my total portfolio value. So I'm likely only going to do 100 shares and one put with my $370. So that's going to be less than 1% of my total portfolio value. Okay, if I open this position. That's just the next step. But many of you say, well, okay, well, why don't you try to reduce this risk right now by taking some money off the table? Go ahead and sell the call now. So I'll go ahead and view options, and July, of course, is a little close. I say go ahead and sell the August 55 call. It's priced about 95 to 120. So let's say we sell it for $1. Now, the first thing here I know I wouldn't do this is, number one, remember my expectation was that I had this feeling a stock might be up at 55 or 55.50 within the next 30 to 60 days, right around the time of August expiration. Part of the rules of income method number one, those of you that own the blueprint know that we really prefer to generate at least a third to a half of our total risk. When we apply income method number one, we're just below that right now. I really like to see at least a third. I'd really like half of that. But let's go ahead and submit this. Now, have I reduced my risk from the 6.3% on the downside to a low range? Yes, we only have a risk of 4.7%. However, if the stock moves up to $55 per share, I've capped my gain to only $107 or 1.9%. And if the stock continues to move up after that, we're giving back to the market. Okay? So remember, you say, oh, but you collected $1 worth of premium. Yeah, but remember, my target price around August 10th was the stock being around maybe $55.50, maybe $56, maybe $55. So if it's trading around $55.50, I'd have to pay 50 cents to buy this back. So I'm already saying to myself, hey, why don't I trade against myself by adding this short call to the position, cap my gain here at only a gain of 1.9%, but based on my target, I have to pay 50 cents to buy that back, so it would be much lower anyway, and my risk wouldn't be down to 4.7%, it'd be down to only 5.3. I still reduced the risk, but remember, I had an expectation the stock was going to go higher. And if I have the expectation the stock's going to move up in price over the next even week or 2 weeks, once I open the position, I want to wait. I want to get a better premium for this call. If I wait and the stock does move up to 53 or 54, I'm probably going to be able to closer to get $1.50 or $1.80 for this call as opposed to $1, maybe even closer to $2 if the stock gets up to near 54.50 or so at that time. So this is one of the better examples. This profit and loss chart is okay. A lot of times what we see when investors try to force an income method is they set it up to where the profit's only about 0.5%. So if I had actually done the December 60 for a lower risk, oops, that's the call, sorry folks, 849.20. Let's just go ahead and buy the December 60 put, and again, seller August 55 call. Okay. I'm gonna put $1 in. Okay, so let's go ahead and do that. See this now, a lot of investors may look at it and say, well, why are you doing the married put? You're trading against yourself. If you're bullish on the stock and you buy a put against it, you're essentially saying that you think the stock's going to fall. No, I'm ensuring a large investment of my capital when I buy the put. That's not trading against myself. That's leaving my upside open and protecting against large downturns. If I try to force an income method, and we're just looking at the basic income method number one, selling a call against it, now I'm trading against myself. If you ever sell a call below the put strike price or you sell it too soon, you limit your upside gain to a small amount, and that's if and only if the stock's trading right at this price. You now have a very tight range of an upper lower break even, and you almost doubled your risk, not to the downside, but in the upside and the direction you thought the stock was going to go. That's trading against yourself, and that's why you never want to try to jump in and sell the call too soon. You don't want to sell it at too low of a strike price because you are now trading against yourself. Your direction you thought the stock was going to go, you're going to be looking at a loss on a position because you wanted to try to generate a premium right away, but you completely reversed the position. You're now in a bearish position, a neutral to bearish position instead of a bullish position. Okay, but this is running the what if scenarios. This is what I want to do with this strategy. After I've got all the positions in place, I've looked at the stock chart, the company information, the news, the profile. I'm still comfortable with the stock. Now I want to go ahead and run my what if scenarios, and we want to go back here to our December 55 put with a 520 to 580. So I'm going to actually put in a buy price here at 550 because I'm going to go to midpoint if I'm going to attempt to open this position. Oh, sorry folks, 550. There we go. All right, so now it's starting off with only a 5.8% at risk, trying to take advantage of a little cheaper price there, get down to $3.40 at risk. Still would only do 100 shares in one put, trying to keep my total monetary risk less than 1% of my portfolio. Now that we've decided the trade, that this is the trade that we might enter, last thing I want to do is go ahead and add it to the portfolio. So I can do it directly from the search. I could select add to portfolio from the search, or we could use the button there that we saw on the custom spread tool. So let's go ahead and add it to portfolio. If you haven't created a portfolio yet, of course, you're just going to plug in your numbers there, or your portfolio name and your cash on hand. We're going to put this into the RadioActive Trading webinar, of course. So the system already knows which stock I'm looking at, which put. We're going to put in our midpoint price of 550. Stock has dropped to 52.80. I might even get a little bit better price now for that. We're going to put 100 shares and one put. Okay, and this is a paper trade, so I'm not going to put in commissions. If you're subscribed to Fusion, you may see this trade later on in the day, or you may see a different one from that list. I'm probably going to open a new Fusion trade today, so we'll see which one it is. I'm not saying it's this one yet. Do a little more research and analysis. All right, so let's go ahead and submit that. Okay, so now I'm in the portfolio tools, and I'm tracking my portfolio positions. See, BCC, there's my new position on Burlington Stores. BCC is probably going to be closed in the next day or two. That just essentially had a bulletproof status on it at one point. We were just holding on to see if we could do any other income methods. Cavium Networks, for example. Now, anytime I enter a position into the portfolio, we can set a variety of alerts. Okay, so when we go into the view field here, for Burlington Coat Factory, we check on that view link. We can set our alerts. What might some of my alerts be? Well, remember we got into the stock here, bought it about 52.80, and we have our put in place. So I may want to be notified in the upper limit if the stock reaches, let's say, around $54 or so. That will be a good time to apply an income method. I'm going to select that as a green alert because that's going to be profitable. On the downside, I may want to be notified if the stock drops down to $47 or so, because if the stock drops by that amount down to $48 or $47, about 4 points from where it is now, that may be an opportunity to do one of the bearish income methods. Okay, so about 5% down or 2 or 3% up, I'm going to select to have my upper and lower stock limits in the alerts. Now for the option price, I'm not really going to worry about too much change in the option bid. I know that. I know what my max risk is. That's fine. But some of the other things I might select, remember what we used in our search. We were looking for stocks that were trading above their 50-day moving average. So I may want to be notified if my stock now drops below the SMA 50, if the trend reverses. And of course, I'll want to be notified if I'm in 3 to 5 days to earnings. We saw that Burlington doesn't pay a dividend, so I'm not going to worry about setting an alert for being with 3 to 5 days into dividend as well. But again, you could set other things for Bollinger Bands or 52-week high and low. We could set option limits. I'm not going to worry about that. I'm just going to set it based on the stock movement and, of course, the trend changing for the stock price to be below the SMA 50 and the days remaining until earnings. Let's go ahead and save alerts. Now on our Burlington position, we do see that our upper and lower break-even of 47 and 54 have been added, and the stock's up 74 cents today, but it's at no change as well from our issue price, 52.80 to 5.50. Okay, now, what are some of the benefits of using the portfolio? Well, as I'm tracking my radioactive trades, or actually any position, covered calls, calendar spreads, naked puts, credit spreads, debit spreads, you name it, as I'm tracking position, we see here this paper trade we entered in a webinar on 2/25. We entered E-Trade at 26.39. We bought the October 31 put, 261, and we set an upper stop limit at 27.50, and the stock's now at 28.39. It is up 7.6% from when we originally opened the position. So that triggered our alert, and we see that an alert has been triggered. So now what am I going to do? Well, now what I want to do is go into my position actions, and of course, if you need to add an option leg, if you did sell a call against this position, you'd select that here. If you're going to close a leg, you made a mistake on the trade entry or put in the wrong commission, you need to edit the position. Or if you just want to delete the position or add a dividend, you could do that as well. But I want to go to position analysis. The position analysis tool gives us a breakdown of your current position, including any or all closed transactions that you've had. So if I had sold calls, if I had sold calls against this position, they expired worthless, my effective cost per share would be lower than the 29.10. We're holding an October 31 put. We did do an adjustment on this, by the way. Original price, remember, was 26.39, but we increased our cost base to 29.10. Why? Because we used income method number 4 to roll from the 29 put up to the 31, and that reduced our cost basis to 71 cents or 2.2%. This is the current standing on our radioactive trade. Now, I scroll down below, and we do see that we have a negative liquidation value and a future expiration value 99 days of a loss as well. That's if we held it, did nothing. But down below, we do see some rollout opportunities. Okay, and the stock says it's fallen by 2.4%. Well, how is the stock up, but it's fallen 2.4%? Well, it's fallen 2.4% from when we did our last income method, and the stock was trading around $30.25 per share. So I could generate some income, generate a credit, and lower my break even, but it would increase my risk by using income method number 9, or I could use a combination of income method number 9 and income method number 1 to lower my cost. Okay, so when there's income methods that are available based on the rules in the blueprint, you'll see that available in the rollout opportunities. The new maximum risk calculation will be there for you, as well as your new break even, and in most cases the probability as well. So if we saw income method number 1 opportunity selling a call, we'd also see the probability of getting assigned and earning that return. Okay, now, I'm sorry, folks. I want to go back to the portfolio. So I looked at the income methods, and I feel that, okay, the stock's at 28.39. We've had to pull back the last 2 to 3 days, a big one the other day. I'm holding the 31 put to reduce the risk factor here, but I don't think I want to go ahead and do that income method number 9. I'd rather see what opportunities didn't show up for me in income method number 1 or in income method number 6. So again, as you're tracking the positions in the portfolio, so let's go to Sun Edison real quick. I'll show you an example of that real quick. So we're going to go to position actions on Sun Edison. We got the stock at 26. We're again holding the October 31 put. The stock's at 29.64. When you go to position analysis, we see here we increased our cost basis once again up to 28.25 by rolling up the put with income method number 4. Stock's at 29.64 here. We got the October 31 put, so it's 2.4% at risk. And here's some rollout opportunities for income method number 1. We could sell the August 31 call for $1.19, and this actually would take our risk down to 44 cents, negative 44 cents, or negative 1.4%. What does that mean? This means that this would actually bulletproof our position. So it's great to see things numerically when SunEdison, how we could bulletproof this position, but I want to see it graphically. So I'm going to go to the More Information button. We're going to select Simulate Trade. And what we're looking at here on the left in red is our current position on SunEdison, where you have a max risk of $75 or 2.4%. And our current return is 4.5% if we liquidated this position. However, if we sell the August 31 call for $1.19 with a stock at $29.64, we're going to take our risk down to negative $44. On the right in blue is what it would look like if we entered this position, and we still have a max return of 9.8%. And then down below, we're seeing the graphical interpretation. Stock's at $29.64. August is roughly about 40 days away. So we see here we have a capped return with this income method number 1 at $300. However, if the stock pulls back, we've got a guaranteed profit of at least $44. No matter what the stock does, we've now bulletproofed the position. And of course, if the stock does go above our short call strike price and we don't do anything, we're giving back because we're not gaining any more on the stock at this time. And we're still losing money on the put because we capped the gain with the short call. Now, add the red line back in. This is our current married put position. So why is it important to look at these side by side? Well, just as we looked at when we analyzed our original position and we tried to say where we think our expectation is for this stock going forward, and that's where we want to select our strike. If my expectation, since I've been in SunEdison for a few weeks now, if my expectation is the stock might be trading up at $32 or $33 per share in the next 20 to 30 days because we've got earnings coming up and I think it's going to be positive and I think there's going to be continued growth, I probably don't want to use income method number 1. There's probably a better income method that I could use to maybe bulletproof the position and still realize further upside, or still generate some income and still realize further upside. That would be income method number 4 and income method number 6. So what this chart, going to the Simulate Trade feature from the position analysis view, allows you to do is apply what Kurt calls your SIGA model. What are the current conditions, your expectations, your goals, and that will determine your action. So if I think SunEdison is going to stay around this range or pull back a little bit because it has a nice run, this is a smart income method number 1 play. But if I think it's going to move up further, of course, and that it might be trading as high as $34, $33 per share, I probably don't want to do this income method number 1. I'd be better off using a different income method, maybe 4 or 6, or leaving the position alone and looking for a better opportunity in the next 2 or 3 weeks or so. If the stock continues to move up, if the stock goes up above 31, we'd have a much better opportunity to do an income method number 5 or potentially an income method number 6 and have a much better profit and loss chart. Still bulletproof our position most likely and still give us a high upside return. But that's the SIGA model approach when you're doing the income methods. Don't just select an income method because it's available. Make sure the graph of the new position matches your target and your goals and your expectations going forward. And of course, if I wanted to add this to my portfolio, to my position, we would just submit change to portfolio, and now we'd be tracking that position on SunEdison. Okay? So we don't see any income method number 6 is available right now, and it's probably because the option prices are slightly different. Oh, sorry, folks. Let's go back to where I was. There we go. Good. Okay. So that's just tracking the positions with the portfolio, the research and analysis, and also applying your own research and analysis when you're tracking positions in the portfolio tools as well. All right. So that's basically what I wanted to cover today. We've went a little few minutes over on our presentation, of course, but that's how I approach my positions with researching and analyzing. Make some tweaks to the default search in the Married Put screen, match my risk-reward tolerance and the stock price I'm going to use. Once I've identified the position or I've changed that criteria, I'm going to go through those 5 steps using the More Information button for further research and analysis. First thing's always the stock chart. And if I'm not comfortable with the stock chart, I'm just going to move on to the next position in the list. Want to make sure I take a look at the company information, the news, and the profile. Make sure there's nothing out there that can't be seen on a stock chart or in a technical or fundamental criteria that may cause me hesitation for entering the position. I want to compare it to other strikes that maybe didn't come up in the search to see which one best suits my needs, specifically now after I've already looked at the chart and have an expectation for the stock again. And last but not least, I'm going to go to that profit and loss chart, run my what-if scenarios, maybe evaluate an income method as well to see I don't do income methods right away, but I might show an example like we did of income method number 1 or number 6 to see what it'll look like going forward. And remember, we use the default search because it's worked for us and we're comfortable with those settings. But as earlier we mentioned, as Paul mentioned, you can put in your own stock list and screen against those stocks. You want a bullish to neutral stock as your underlying. Use the criteria that you would use to identify a bullish to bear or bullish stock for your investment needs. But then keep the 3 core principles in place. Keep your expiration time frame at all months and at least 150 days out. Keep the percent in the money range to less than 20. You can extend it up to 25, but I'd keep it there. And keep the maximum risk within range, reasonable range, under 8%, under 9%. And you don't want to go below 2% and filter yourself out there as well. Hedge yourself out too far. I'm sorry, Rick says, oh, thanks, Paul. Rick says, this is one of the best webinars you guys have put on, very informative. Well, thanks, Rick. I'm glad you enjoy it. I tend to do the Power Options for Radioactive Trading webinars once every 2 months or so, especially when Kurt's on vacation. It's just easier for me to do to get the blueprint owners and other members interested in radioactive trading to see how I actually use this when I'm opening my positions. And Bill says, will this be recorded and available for us to watch again? Absolutely. I typically record these presentations so investors can always see how I use the tools for the radioactive trading techniques. Let me switch screens again, ladies and gentlemen, real quick here. Okay, but what's typically going to happen, okay, let me go back here, I'm sorry. What I typically do with the recordings here for Power Options for radioactive trading, I don't post them on radioactive trading. I'm going to post it on Power Options. And the Power Options, excuse me, folks, the Power Options webinar page is a free page. You don't need a trial right now. You don't need to be logged in to your personal account. It is a public page. I'm going to send that link to everyone right now. It's powerop.com/webinars.asp. And when you go to this page, you have webinars on the PowerOptions Tools, the options strategies and options concepts. If you go to options strategies, you see our most recent PowerOptions for Radioactive Trade was on February 25th. I'm going to replace this one with today's presentation. It'll be archived here for you. So just go to powerop.com/webinars.asp, click on options strategies, and you'll see that one right here at the top from today's presentation. After conversion and cleaning up the video a little bit, it probably won't be available until 5 p.m., 6 p.m. Eastern time this afternoon, but that's when we'll be able to identify it, and I'm going to send everyone an email as well once this webinar is up also. Okay, so that being said, let's switch screens once again here to wrap up. I just want to remind everyone, of course, if you have any last-minute questions, go ahead and send those in. We can still stay on here a couple more minutes there to handle any last-minute questions that might come in as well. Last but not least, of course, when you're creating a search from scratch, just remember, clear the settings, input the 3 core principles, and then just put a few basic criteria in at a time. And then if you still have too many results, you can narrow it down further. Every time you enter one or two criteria, go ahead and hit the submit button. You don't always want to jump in 10 criteria at first and then try to run the search. Simply because you might end up with no results and you don't know which combination of the 10 different criteria used that really hindered your results. It's best once you set up your basic criteria that you wanted, stock price, maybe earnings per share growth, maybe average stock volume, market cap, or the technicals, MACD ranges, Bollinger Band ranges. Once you've put those in, just start doing 1 or 2 filter at a time to get your list down to a nice manageable list of maybe only 20, 25 to 35 results. For those of you that are curious, if you haven't yet, Bill says, how do I sign up? If you haven't yet, I just want to remind you that you can take a 14-day free trial to Power Options at any time. I'm sending this link to everyone as well. Just go to powerop.com/RAT. On the right-hand side, you'll see a field for just your name, an email address. Fill that in, hit start trial. We'll send you a password and you have full use for the Power Options tools for 14 days, okay? Now, investors, of course, who purchase after that, I'm sorry, let's say on this track here, after your trial, the 20-minute delayed service gives you access to all of the tools that we saw today, but for all 23 different strategies and portfolio tools, that's $60 per month. Of course, you do get a discount for an annual subscription. We do offer a real-time service, so every time you refresh the page or submit a new search, you're getting the numbers and calculations at that very instant, and that's $100 per month with a discount of $1,100 per year. On both those level of service, we do offer access to historical suite of tools. Backtesting search is the same function that we saw in the search, but you can select a date back in time to see what trades would have matched your criteria on that date and then track them forward. Full historical option chains as well, and of course the historical search by symbol. The historical suite of tools are $40 more per month on top of the regular subscription, so be it $100 if you added historical to the 20-minute delayed, or $140 total for the real-time and the historical. And right now we are also offering a end-of-day service as well with a lower price. Now, some of the bonuses that you get if you haven't picked up the blueprint yet, of course, the blueprint is the only place where we describe the full radioactive trading setup, more detail of what we discussed today about stock selection and selecting the right strike price of the put, and the full details of all the 12 income methods that we use in different scenarios. If the stock moved up, the stock stagnates, the stock falls in price. The blueprint is the only place that describes all of that. And if you pick up the blueprint, you do receive several bonuses. One of them is a full free month to PowerOptions, which starts when you're ready. You don't have to start it right away. So you get a full 30 days to PowerOptions. We have something called a quick start guide that Kurt put together. You can, as a blueprint owner or PowerOptions member, you can sign up for those free coaching sessions. Kurt has 6 Mastery Series CDs that he put together. You get one of those for free if you purchase the blueprint. And then the Fusion service I mentioned, where you can track Ernie's radioactive trades, my radioactive trades, see Kurt's track record, about 70 lessons, 60 to 70 lessons that Kurt has put together for you, and I'm actually listing several more as well, of course. And then the you get a discount of that, so you can get your first month of Fusion for only $10 as well. And the blueprint also comes with a money-back guarantee. If you're not satisfied with the content or you don't think it's for you after you get the product and you review it for the first 30 days or so, just go ahead and send it back to us, and we'll go ahead and refund your purchase price. And the link that you can go to see these special bonuses is radioactivetrading.com/iridium. Bill asked, is the blueprint the same as the home study kit? No, it is the same, but it's slightly different. And let me take a look there. Oh, sorry, folks. Let me go to radioactivetrading.com real quick. I'll go to the link and show you the quick description of the two. Okay, sorry. Sorry about that, folks. Let's go ahead and get that over there. There we go. And I forgot the E. How silly of me. Let's try that again, shall we? radioactivetrading.com/iridium. Okay, now, the blueprint does contain everything you need to know to trade radioactively. It's in a printed binder. It's about 250 pages. It goes through all of the income methods, the discussion we had a little bit ago on exiting an RPM, further details along those lines. So the blueprint contains everything that you need to know to trade radioactively. But a lot of investors prefer to learn more in a format such as this, through video presentations, discussion of the income methods and the trade setup through video, as opposed to reading through a text and maybe just use the text as a reference. The Home Study Kit includes the blueprint and the 6 Mastery Series CDs that Kurt put together. And the 6 CDs, of course, are the Foundations of Radioactive Trading, which walks through those 3 core principles in depth and position setup. It's discussed in the blueprint, but it's in more of a video format. And then the income methods one come next. The next disc 2 is income methods of beginnings, where we go through income methods number 1 and number 2, the full description of the SIGA model for each, when you would use them, how you'd use them in a video format. 3 is looking at income profits with puts, income method number 3 and 4. Disc number 4 is the money nets, income method number 5 and 6, the riskless spread trades you can use in the radioactive trade. Advanced income methods, looking at income method number 7, number 8, 9, and 10. And then combining methods. A lot of times when I use income method number 4, I'll combine it with an income method number 6 to help pay for some of the adjustment I just made. Or I may use a 1 and 3 in combination together, or a 5 and a 4, or 5 and a 3 rather, depending on my outlook for the stock going forward. So it's a video format as well. So you get the full blueprint at $339, plus you get the 6 Mastery Series CDs as well if you go with the Home Study Kit. And I just want to remind you that if you do purchase the blueprint, of course, at $339, as a blueprint owner, you can choose to upgrade to the Home Study Kit at any time for just the difference. The 6 discs by themselves would usually run you about $450 to $480. If you're a Blueprint owner, you can upgrade to the home study kit for only $260, the difference between the current price of the Blueprint and the current price of the home study kit as well. So if you wanted to start off slow, you could just buy the Blueprint. Remember, you get the money back guarantee. If you decide to return it, you receive all of the bonuses that are available, and you can upgrade at any time the home study kit for just the difference of the cost, even if you decide to do it months later or even a year later as well. So you want to check out radioactivetrading.com/iridium to take a look at the bonuses that are currently offered and the full description on what you're getting with the Blueprint and the home study kit as well. Okay, so those are the subtle differences there, Bill. I wouldn't say subtle differences, but those are the differences there, Bill, between the two. It's just the difference between the 6 Mastery Series CDs, of course, versus just the static Blueprint by itself. But as a Blueprint owner, you'll be able to upgrade to that at any time. Okay, well, I think I've covered everything I want to, folks. I don't see any other questions coming in. If you do think of a question later about the presentation today, you can reach me at any place. You can send me an email to support@powerop.com if you have questions regarding the PowerOptions tools. If you have a question about the radioactive trading techniques, the setup of the married put position, income methods, or of course even the Blueprint or the home study kit, send us an email to support@radioactivetrading.com. And both Ernie and myself are available here in our office during market hours. You can reach us at 877-992-7971 or at 302-992-7971 if you live outside the continental U.S.